Ratio analysis expresses relationships among data. Financial ratio classifications include liquidity that measures companies' short-term debt-paying abilities, as well as unexpected needs for cash. Profitability ratios measure companies' income or operating success. Solvency ratios measure companies' long-term ability to survive in the long run. Ratios can be used to measure a company over time in intra-company analysis. Competitors' ratios can be compared with intercompany analysis, or a company's ratios can be compared to industry averages. Liquidity ratios can provide useful information on the short-term debt-paying ability of companies. Short-term creditors are particularly interested in measuring liquidity to determine the likelihood they will be paid back. Liquidity ratios include the current ratio, acid test ratio, receivables turnover, and inventory turnover. You will note that all of these include current assets in the calculation of the ratio. The current ratio is calculated by current assets divided by current liabilities, which equals current ratio. For quality, the current ratio of current assets divided by current liabilities is written as 2.96 to 1. This liquidity ratio means that quality has $2.96 of current assets for every dollar of current liabilities. Higher ratios are stronger ratios. Using Quality's 2007 data, liquidity ratios will be further demonstrated. The acid test ratio is calculated by dividing the sum of the current asset accounts cash, short-term investments, and net receivables by current liabilities. Quality's cash, short-term investments, and net receivables divided by current liabilities is 1.02 to 1. The acid test ratio measures immediate liquidity because it includes the most liquid of assets in the calculation. The acid test ratio for a company will be smaller than its current ratio. Another liquidity ratio is the receivables turnover ratio that has net credit sales in the numerator. Net credit sales are gross sales minus sales discounts and sales returns and allowances. The net credit sales are divided by average net receivables. Net receivables are gross receivables minus the allowance for doubtful accounts. The average is calculated by adding the beginning of the year net receivables to the end of the year net receivables and dividing by 2. For quality, the net credit sales divided by the average net receivables is 10.2 times. The receivables turnover ratio measures the number of times the company collects its receivables. Quality collected its receivables 10.2 times during 2007. A variant of the receivables turnover ratio is the average collection period. The average collection period is calculated by dividing 365 days by the receivables turnover ratio, which calculates to 35.78 days for quality. On average, quality collects its receivables every 36 days. The last liquidity ratio we will examine is the inventory turnover, which is calculated by cost of goods sold, which is located on the income statement, divided by average inventory, which is calculated from data on the balance sheet. For quality, the inventory turnover is calculated to be 2.31 times. Inventory turnover measures the number of times the inventory is sold. Similar to the accounts receivable turnover and average collection period of accounts receivable, a variant of the inventory turnover is the days in inventory. For quality, the days in inventory is 159 days. Inventory turnover ratios vary considerably among industries. Grocery stores, for example, have large inventory ratios because they sell their inventory quickly versus other industries, such as car dealerships or expensive jewelry stores, that take much longer to sell their inventory. As with the current ratio and acid test ratio, larger versus smaller accounts receivable and inventory turnover ratios indicate stronger liquidity. Profitability ratios measure the income or operating success. Income affects a company's ability to borrow or issue stock, its liquidity position, and ability to expand. Profitability ratios include the profit margin, asset turnover, return on assets, return on common stockholders' equity, earnings per share, price earnings, and payout ratio. All of the ratios include an income statement item in the calculation. The larger the profitability ratio, the stronger. The profit margin is calculated by net income divided by net sales, both of which are located on the income statement. Quality's profit margin is 12.6%. The profit margin measures the percentage of each dollar of sales that results in net income. Related to quality, for every $100 of net sales, there is net income of $12.60. The profitability ratio, asset turnover, is calculated by net sales and income statement item divided by average assets. Please remember, when the calculation includes an average, it is determined by adding the beginning of the year balance to the end of the year balances and dividing by 2. For quality, net sales divided by average assets calculates to an asset turnover of 1.22 times. The asset turnover measures how efficiently a company uses its assets to generate sales. The profitability ratio, return on assets, is calculated by net income divided by average assets. Quality's 2007 return on assets is 15.4%. The return on assets provides an overall measure of profitability. For quality, for every $100 of assets, a net income of $15.40 is generated. Another profitability ratio is earnings per share, calculated by dividing net income by weighted average common shares outstanding. For quality, the earnings per share calculates to 97 cents per share. Earnings per share measures net income earned on each share. Each share of common stock earned 97 cents in 2007. The profitability ratio, price-earnings ratio, is calculated by market price per share of stock divided by earnings per share. Quality's price-earnings ratio is calculated to be 12.4 times. The price-earnings ratio reflects investors' confidence of a company's future earnings. Investors that believe a company has a positive financial future will be willing to pay more for each share of stock. As with other profitability ratios, the higher the ratio, the stronger the ratio. The last profitability ratio to be discussed is the payout ratio that is calculated by cash dividends divided by net income. Quality's payout ratio is calculated is calculated to be 23.2%. The payout ratio measures the percentage of earnings distributed in the form of cash dividends. The third type of ratio to be examined are the solvency ratios that measure a company's ability to survive over a long time. The debt to total assets and times interest earned are two solvency ratios. The debt to total assets is calculated by total debt divided by total assets. Note that the amounts to be used in the calculation are not average amounts, but as of a single date. Quality's debt to total assets is 45.3%. The debt to total assets ratio measures the percentage of total assets provided by creditors. The lower the ratio, the stronger, because a smaller ratio indicates a smaller debt percentage. Another solvency ratio is the times interest earned that is calculated by using income before income taxes and interest expense, sometimes referred to as EBIT in the numerator. This amount is divided by interest expense. Quality's times interest earned is 13 times. Looking back to slide number 6, $468,000 is calculated by net income of $263,800 plus income tax expense of $168,200 plus interest expense of $36,000. Times interest earned indicates a company's ability to meet interest payments as they come due. The larger the ratio, the stronger, because the company has more earnings to cover the interest payments.